Today, we are covering the healthcare sector. If you remember back in December, we put out a video that covered the three best sectors to invest in while interest rates were rising. Healthcare happened to be one of them, so I figured I'd do a deeper dive to figure out which areas or which ETFs you could invest in, especially those that are trading on the Toronto Stock Exchange. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, if you get some value or you learn something new, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for content similar to this. I've been able to put together 6 ETFs, which we'll be covering, and you'll be able to go and do your own research from here to figure out which one may be best for you. But I'll definitely give you some inclination as to what I'm invested in and where I could potentially be going moving forward. So we're going to start off by looking into a BMO product. The ticker symbol is ZUH. It's an equal weight US healthcare and it's hedged to Canadian dollars. In all of these, they're going to be hedged to Canadian dollars because of the fact that for the most part, these healthcare companies are trading in the US and they trade in US dollars. So to take away the currency risk, we're going to have them all hedged. Now, if you want to learn more about that, I'll link my video about whether to invest in hedged versus non-hedged, but we go further here. So what I really like about this one, and we'll see in a little bit, is that equal weight, meaning that they have a wide variety of companies, which is another beautiful part about ETFs, that you invest in one fund, but you get coverage over a multitude, a big, large amount of customers. But we'll see a little bit later in the holding. So you can come down here, get an indication of what the management expense ratio is, how much you're paying for them to manage that fund on your behalf. And we see here it's at 0.39. We also see the distribution at 0.13. And obviously what's really important is figuring out risk rating and figuring out what is best for you. We can see here that they're eligible for all of the registered accounts in Canada. But more importantly, what is in there? We're going to see what's under the hood. Normally they show you the top 10 holdings. And again, about the equal weight, you'll see here that they kind of vary between 1% to 2%. And we can see all of the companies that are held within this fund. So TDOC, obviously big company. I'm not going to go in and discuss too much about what it's holding, more in the sense of giving you an indication of how to go in here yourself and figure out what one may be best for you. So we can come and scroll down here and see the fact of all the different companies you get exposure to by buying ZUH.TO on the Toronto Stock Exchange. And we can also see here what the sector breakdown is. So healthcare equipment, biotech, life sciences, pharmaceuticals. For me personally, I definitely like the healthcare equipment. There's been a lot of surgeries that have been put off coming from the pandemic. We expect that these surgeries will continue to increase, companies like Stryker and so forth. So having a high exposure to healthcare equipment could be very interesting if that's something that you agree with. Biotech is obviously a lot of this next generation that's coming in and higher risk, high reward, but it looks like they back it up with a little bit more consistency. So we can take a look at the performance as we scroll up to the top and see how it's performed over a 5-year period. And you'll be able to see here that it's done about 78 to 80% over a 5-year period. Now, obviously, on the grand scheme of things, we want to buy and hold. That's my personal preference when it comes to investing. We're not buying for a trade. We're not buying for tomorrow. We're not buying on a swing. I want to put money into something and watch it grow over a longer period of time. So we'll move on here pretty quickly. Now that we get an understanding of what my personal investing is all about, we move on to the next product, which is First Trust AlphaDEX. This is a US healthcare sector ETF. And we can come here and we can see the same type of information that we were looking for from the BMO page. We have the management expense ratio at 0.76. I've put this all together into a Excel document so we can review it later. We can also see that I do not believe there is a yield on this one. This is just a straight growth. And again, the top 10 holdings, you'll be able to see what it's invested in. And it kind of has the same type of setup as the ZUH in terms of allocations in each company of 1 to 2%. So we see AbbVie, Pfizer, a lot of big names that are included in this fund. And we again come down and we can see the portfolio composition. So we can see medical equipment is again 40% of this fund, pharma, bio at 37 and so forth. We can actually see a little bit of a country breakdown here, see what countries they're invested in. Of course, this one is hedged to the Canadian dollar as well, but we have United States, Ireland, Netherlands, and the UK, so a little bit of diversification there. You can go down even further, take a look at performance. Obviously, again, going back to the 5-year claim that I had there, 5, 10 years forever. 10.6% it's done annually since its inception there. We can also take a look at holdings. So again, like the ZUH approach, a lot of funds here ranging from 0 to 2%. So there's not one particular company within this that is kind of eating up a lot of the ETF. So definitely a good one to take a look at. We also take a look at TDOC. So very familiar. It's the same ticker symbol as TDOC, but this one, of course, would be traded on the Toronto Stock Exchange and is hedged to Canadian. This one is a relatively new one, so we won't be able to go back that far into history to take a look at what the performance has been, but it seems to be one that kind of follows along with all of the other products in the market. So it's a TD product, of course. Its management fee is 0.35 here. It pays a 1.55% dividend yield, and you would be able to find that out by looking through this sheet here to see the dividend date, ex-dividend date, etc. And that is what it's at now. So we look here, we can see the portfolio analysis. We see the US equity 65%, international 35%. We get an even further breakdown to see, where the fund is geographically invested, where the sector mix is. And then we also see the top 10 holding, which we have been looking through a lot. It seems like this fund is a little bit more segmented into the pharmaceutical side of things. AbbVie, AstraZeneca, Eli Lilly. We can open this up, see the full list, and take a look at what else it's in. Johnson & Johnson making an appearance, Pfizer, etc. Then we start getting into the strikers and so forth. It seems like there is a lot of holdings in this particular ETF and could provide a lot of diversification. So looks like on the lower end of scale, they have some genomics in there, which is obviously where they expect it to go. Again, we touch on the dividend yield, 1.55%, which is relatively good because a lot of these companies don't really pay a yield. Even if you look at Johnson & Johnson, been paying a dividend yield forever, but they're not high in the US. So definitely a good one to take a look at. We move on to an iShares product. Again, Canadian hedged, ticker symbol is XHC. And we start off by taking a look at the performance, done about 11.79% average annually. It even shows the cumulative, so 75, almost 75% total return over a 5-year period. It pays a distribution, but let's take a look. So trailing yield is 0.75, which is just less than 1%. And I believe the MER is 0.63, 0.65 here. And again, we look at the top 10 holdings. So the iShares products are a little bit differently built in the sense that they carry the main fund in the US. And then what the Canadian hedge does is they go and they buy shares of that fund, and then they do their currency magic in the background. So we can see here that they're holding IXJ, and you would be able to go and search up IXJ and see what's under the hood there. So it's just a matter of doing a little bit more homework and figuring out there. We can see exposure breakdowns as well, whether it's geographic or it's on a sector basis. Like I said, it looks like this one is highly into pharma, bio, and life science, a little bit more on the risky sale. Healthcare and services is a little bit lower. So we move on to the next one. And these next two products are going to be income. So for people that definitely like that yield in their portfolio, like we said before, these healthcare companies don't really pay out too much. They like to put that money back into research and development, R&D, to continue to put new products back into the market. You can see once you start doing research that there are other funds, but for the basis of time, we're going to just start on the hedge, the Canadian ones. And this one is called the Evolve Global Healthcare Enhanced Yield Fund. Ticker symbol is LIFE on the Toronto Stock Exchange. And the way that these companies are able to generate more yield is by using covered calls. So if you're not familiar with covered calls, we've touched on this topic a couple weeks ago. I'll link it above. But they're using options and the option premium to generate more yield. Now, one of the downfalls and one of the cons is that when you are in a bull market and you're using covered call options, you play the risk of losing those shares, because if the market goes up and it hits that strike price, then you'll have to sell your shares to the other portion of the contract. So this fund could be definitely useful in a sideways market to capture that yield, but obviously still have exposure into the sector. So we'll take a look down. Like I said, it's got different funds. It's got an unhedged, it's got a USD. The ticker symbols will pop up here depending on which one works best for you. But again, we'll just stay with the hedged Canadian for now. And we can get some indication of just how juicy that yield is. And we can see the target yield here, 7%, which is definitely a lot better than the 2 or less percent that we've been seeing so far. And we can take a look at what the portfolio is comprised of. We can see here the different geographic allocations that it's in, and also the sector, obviously being healthcare. Continuing to scroll down here, we start to see what is underneath the hood. Top 10 holdings, of course. You would be able to drop down, take a look at all of them. And we can kind of see the same type of companies that we've been continuing to see throughout all of them, but a little bit more of like getting deeper into companies. So a little bit less diversification and a little bit more specific into direct companies. So definitely something to take a look at and something to consider. The MER we will cover again at the spreadsheet at the back. The last one that we have here is HHL, and this is a Harvest Healthcare Leaders Income Fund, again, using covered call options to produce yield. And we can see here the distribution is 7.73%, which is definitely juicy and definitely very good, especially for all those income and dividend investors out there. And we can see here, this one again, hedged the Canadian. We can see what the performance is over the past 5 years. And we can see here what the overview is of the fund, what they're looking to do. Obviously, using covered calls and option strategy in order to bring yield to the investor. We take a look at the portfolio. We see that it's only 20 companies that are in there, and obviously breaking down what the different sectors are. So for the most part, pharmaceuticals, healthcare next, biotech coming in later, and again, the geographic location that it's in. So we'll take a look here, see what the 20 holdings are, and we can see again a big preference into companies directly with not as much exposure into companies. So if that scares you, if you do think we're heading into a bull market, these ones may not be the best for you. Full disclosure, I do own this one myself. I've owned this one for probably about a year and a half. I've been enjoying clipping this yield, but we'll discuss at the end where I could potentially see myself going. So Again, what I mentioned is I put this together into an Excel spreadsheet, providing what the last price is, if that's definitely a consideration for you. Again, it should have no basis. Just buy less shares with the amount. Just know how much you want to invest and work from there. We can see what the dividend yields are for each of them. We can see the MERs, or how much the fund is going to charge you in order to be invested. And we can see what the 1 year and 5 year returns are. Now, I have not included dividends in these returns, so they will be a little bit skewed because obviously you want to factor that in. But we can start to see and start to visualize what may be the best for you. Is this a growth sector? Is this an income sector? Are we in a bull market? Are we in a stagnant market? Just putting all of these on the table. We go back into Yahoo Finance here, and what I've done is I've loaded all of these companies, and what we're looking at right now is a 1 year performance, and we can see a trend here. We can see a trend, in the sense that they all kind of move together, minus ZUH, which happens to be a little bit more into the pharma, not so much into the equipment, and it seems like they have a lot of ways to come up here. We can also take a look at what the 5 year performance is. Now, the HHL, which I own at the bottom, obviously doesn't look the greatest. This, again, does not consider in dividends. But again, a sector that doesn't really pay dividends and should be, if you're going to use this during a sideways market, it may be a good opportunity. But obviously, again, up to your own preference and up to your own what you decide to use. So when I look at this and when I've been doing all my homework, I think what we're going to see is more spending from governments, especially in the healthcare sector. It's definitely a sector that with an aging population has a lot of room still left to run. It's obviously performed very well, doing 10% for most funds year over year for the past 5 years. I think I'm going to transition out of HHL. I think I'm going to take my profits there up like something like 20%. And I think I'm going to start looking at either the BMO or the iShares product. Those two happen to be the best for me. I definitely like the TD product, but there's just not enough history there. I know it shows about 96% return, but again, this product is brand new, and I think this is a little bit skewed. So I think I'm going to take a look at what iShares and what BMO has in store. I personally like the healthcare equipment side, but obviously don't want to neglect and negate anything on the bio or on the pharmaceutical side of things. So those are the ones that I'll be looking at moving forward. But I haven't forgot about HHL because it's definitely been useful for me to clip some yield in the interim while we wait for kind of this dust to settle over the past 6 months. But yeah, this is kind of where I'm looking, and all the funds that I was able to provide that provide you with healthcare exposure on the Toronto Stock Exchange. So let me know down below if there's one that you prefer, or let me know if I've missed one. But if you're still here with me, I hope you enjoyed the video. Please hit that like button for me. And if you haven't already, please consider hitting that subscribe button. I hope you all have a great week in the markets. Happy trading.